Derivatives have been given a bad rap. If used the incorrect way, yes, one can lose big time. And recently the news about derivatives is how they've been used in a manner that is careless, leveraged, and risky. But derivatives were not created to add risk. They were originally intended to remove risk or to hedge risk. So you will learn that a portfolio utilizing derivative strategies appropriately is a portfolio that is less volatile, more profitable, and absolutely exposed to less downside risk. Indeed, there are derivative strategies that employ 41 times leverage. I'm not going to teach you those today. Just the practical ones that are suitable for any personal investing account, your retirement monies, a child's education savings, and corporate cash reserves. I also assert that the first strategy I show you, the Hedged Income Index ETF, is one that is safer than any common mutual fund, period. Recently, something very bad happened. It hurt many people. Some will not be able to retire when they anticipated that they might. People are discovering that their nest egg is not capable of sustaining the lifestyle that they enjoyed just a few years earlier. And some have to go back to work. Why? Because the value of their investments on March 9th, 2009 was equal to the value of their investments on September 9th, 1996. How come? The answer is here in the orange box, and the reason is here in the purple box. You've got to understand the history of this matter, or else you'll be destined to repeat it again and again. And I suspect it hurt the common American plenty the first time. To define common American, I mean someone who doesn't have $25 million of liquid cash to invest in a legitimate hedge fund. I mean most everyone else who had their money unhedged in mutual funds. This lecture will teach how one can interpret and understand what the broad market is going to do with predictive indicators, recessionary and technical. A general hedging plan will be described in detail and will include case study results for analysis and understanding. Why was money lost? The answer is because these four indicators were either missed or misunderstood. From the October high of 2007 to the March low of 2009, 57% was lost as measured by the broad market indicator, the Standard & Poor's 500 index. First, recessions come on average every 9 years. That doesn't mean wait for year 9 to start preparing. It means start keeping an eye out on the total group of indicators around year 7. The recession beginning years are on the left, and the time between those years is on the right. Our recession officially began December 2007, but since lagging indicators are used to determine this, the news wasn't published until late June, early July of 2008. Second, the collapse of credit is no small thing. Third, the nationalization of portions of the world's banking and finance systems. Do you remember Washington Mutual? How about IndyMac Bank for those from California? Or AIG? And the Emergency Economic Stabilization Act? That's scary stuff right there. That should have said something bad is happening. This is number 4 of the predictive indicators. There are 3 extraordinarily powerful tools that can be used to understand the market. In addition to major news, a market moves up or down very much like a herd moves east to west. Singularly, one person or one institution does not have the power to change the direction of the market. It's people and institutions acting in conjunction as a group, as a herd. And the signals that tell them to buy or sell are technical indicators. Since everyone uses them, it's important for us to understand them. And after they're understood, they can be used to anticipate market movements. Now we'll look at the chart types, the TED spread, and the VIX of these indicators. also known as the Market Fear Index. It's the ticker symbol of the CBOE's volatility reading on the S&P. So the VIX tells us that there is a 68% chance in the next 30 days that the Standard & Poor's 500 index could move by the following percentages. Those percentages don't have to be just directional, down or up, though they could be. They can be a combination of both, but the value of this is, the VIX, is that it's telling you that a storm is coming. And when faced with a hurricane, a tornado, or something like a blizzard, you don't just do nothing. So the only way to know if those are close to being right is to test the outlier on October 24th, 2008. On that day, the VIX reached an intraday high of 89.53, and the corresponding calculations yielded a possible percentage move of 25.85% in the next 30 days. So let's see. On October 24th, the S&P was at 876.77, here on the left. Within the following 30 days, which is what this graph shows, the S&P moved up to 1,005.75, that's 15% up, and then fell all the way down to 752.44, and that's 14% down from the October 24th starting S&P reading. Combined, that's a 29% distribution spread. And that's enough to convince me. So plotted against the S&P 500 like the TED spread, the VIX is in white, the S&P blue. Like the TED spread, we notice a historic average with minor highs and lows off the mean. VIX and S&P movements are visually significant and negatively correlated, just like the TED spread was. Its spikes are at least 62% higher than the average, and like the TED spread, each time it settles, it isn't able to return to its historic mean. There's something going on here. Its peak is 4.7 times the historic mean. Here it is graphed naked again. And here it is plotted with the TED spread. If one indicator isn't enough to be convincing, why not two? How about these with the collapse of credit? Throw in the takeover of banks and poorly run insurance companies. Here's the orange box with the answers, and the blow up of the orange box with a lot of bad news packed into that one piece of time. This is really hard to miss. Now I'm going to explain a hedge strategy investment plan. Question: what's a proper investment plan? An investment plan is fully defining the risk and reward, not let's throw some money at it and see what it does. It is a series of predetermined steps, completely planned to cover any and all possible outcomes. If there is a question as to what to do next, the investment plan has the answer. When do I get in? When do I get out? It's already there in the investment plan. The objective of the hedged income ETF derivative strategy is to beat the market as measured by its ETF proxy, the SPY, the DIA, the QQQ, to earn consistent income from multiple sources. And those would be sold derivative contract premiums and ETF dividends. To abate losses and backtracking, and that's done through hedging, and to time the market. This is the Dow Jones Industrial Average as mimicked by the DIA ETF. This data is provided by the prospectus from this ETF. It uses general after-tax numbers. Its average annual return over these 10 years was a little over 3%, and that's pretty terrible. Notice that there were good years and there were bad years, and the reason why the performance is so low is because of those bad years, and the cause is backtracking here in red.